You walk into a bank with a steady job, a clean record, and money in the account. You're told no. Across town, someone with less income, more debt, and fewer savings gets approved instantly. Same economy, same day, different number. That number isn't your income. It isn't your intelligence. It isn't even how much money you have. It's your credit score. And quietly, almost politely, it decides who gets to build wealth and who doesn't. Right now, credit scores are more powerful than ever. Interest rates are high, debt is expensive, assets are scarce, and the gap between people who can borrow cheaply and people who can't is widening fast. But here's the uncomfortable truth. Credit scores were never designed to measure financial responsibility. They were designed to manage risk for lenders. That difference changes everything. Let's talk about how this system actually worked. Not the clean version, the real one. Credit scores didn't exist until the late 20th century. Before that, lending was personal, messy, biased. A banker knew your family, your job, your reputation, and yes, discrimination was rampant. The credit score was sold as a fix, an objective number, hold, neutral, mathematical, 3 digits that would judge everyone the same, except it never did. Modern credit scores are built almost entirely on one idea. Past borrowing behavior predicts future profitability, not stability, not effort, profitability. The system doesn't ask, can you manage money? It asks, how reliably can we extract interest from you? That's not a moral judgment, that's a business model. Here's how the math works. Payment history is king. Miss a payment and your score drops fast. But you only have payment history if you've already been given credit. Length of credit history matters too. The longer, the better. So starting early is an advantage, even if you start with mistakes. Then there's credit utilization. Use too much of your available credit and your score drops. Use too little and it barely grows, which means you're rewarded for hovering in debt, but not drowning in it. Think about that. The ideal borrower is not debt-free. They're comfortably indebted. Someone paying interest, predictably, forever. Now zoom out. Who gets credit early in life? People with parents who co-sign, people who understand the system early, people who can afford to make mistakes without missing rent, and who doesn't. People who grow up cash only, people who avoid debt because they've seen it go wrong, people who are financially cautious but invisible to the system. Irony, number one, being careful with money can hurt your credit score. Irony number two, missing one payment can erase years of good behavior. And irony number three, the quiet one, is this. The score follows you even when you're doing everything right. Let's say you finally break in. You get a decent score. Now you want to buy an asset, a house, a business, an education. The score doesn't just decide yes or no. It decides the price of money. A difference of 50 points can mean tens of thousands of dollars in extra interest over a lifetime. Same loan, same house, different future. One borrower builds equity, the other builds interest payments. And this compounds. Lower interest means more cash flow. More cash flow means more investing. More investing means more assets. More assets improve creditworthiness. It's a feedback loop. On the other side, higher interest drains cash. Drained cash leads to stress. Stress leads to late payments. Late payments damage the score. Another loop, just in the opposite direction. Now, here's the part most people miss. Credit scores don't just reflect inequality. They amplify it. They turn early advantage into permanent leverage. Publicly, the system is framed as fair. Earn trust. Get rewarded. Play by the rules. But the rules are asymmetrical. Someone with wealth can miss a payment and recover. Someone without wealth gets locked out. Someone with assets uses credit to grow. Someone without assets uses credit to survive. Same score mechanic. Very different outcome. And lenders know this. They don't just use credit scores to avoid losses. They use them to segment profit. Prime borrowers get cheap money. Subprime borrowers get expensive money. Both are valuable. One builds wealth, the other feeds the system. This is where the narrative breaks. We're told credit scores protect us from bad decisions. In reality, they protect lenders from unpredictability. They don't measure your future. They price your risk to someone else's balance sheet. And once you see that, certain things start to make sense. Why medical debt can crush a score even when it has nothing to do with behavior. Why closing old accounts can hurt you. Why paying off debt doesn't always help immediately. Why the score feels less like a grade and more like a leash. The system isn't broken. It's doing exactly what it was designed to do. Allocate capital to those who already move predictably within it. Now zoom out even further. Credit scores increasingly decide access beyond loan, renting apartments, insurance premiums, employment screenings, utilities, even phone plans. A private scoring model has quietly become public infrastructure, but you don't get to vote on it. You don't see the formula, and mistakes can take years to undo. Meanwhile, the economy is shifting toward debt dependence. Vageslag, assets inflate, savings erode, credit fills the gap, which means this number matters more every year. Not because it reflects who you are, but because it determines how expensive survival becomes. The real danger isn't that credit scores exist. It's that we've normalized them as destiny, 3 digits as a proxy for trust, worth, future. And the final irony? The people most harmed by the system are told it's their responsibility to master it, individually, quietly, without ever questioning why the system rewards debt before stability. So here's the unresolved question. In an economy built on credit, where access to cheap money determines who builds wealth, is a credit score measuring responsibility or assigning roles? Because once a number decides the price of your future, it stops being a tool. It becomes power.